Hi there, welcome to Kneppy Invest. Welcome to another answer and reply video. This is my third take. The first take, I recorded 1.5 hours of me answering your questions, replying to your comments. And when I went to convert that video via Zoom, for some reason, Zoom said, no, can't do it, can't convert this video. It's lost. So yes, 1.5 hours of answering your questions, replying to your comments, lost for all time. That made me quite frustrated. And then I tried to do a video straight after that, follow-up video, going back in time to answer and all your questions and reply to your comments that I had already done. I think you could have seen and felt my frustration coming through in my answers. So I thought, let's start refresh. Let's start renew, take a little bit of time off, not a lot, maybe an hour or so, and come back and redo this again. Now, this video won't be as long as 1.5 hours because I can't do that again. Plus, I'm a little bit time strained right now. I do plan to record another video after this to release on Sunday, the 16th of June, because I won't be able to do anything on that day because I am completely busy. So let's go back in time, and I might try to go through some of these questions and comments a little bit quicker to get through a little bit more than I might plan to otherwise, but I can ramble on sometimes. Now, Adrian Sarian was the first question or comment I did reply to in my original video, so let's go back there. And this particular person, male or female, more than likely male because it says Adrian, but it could be Adriana. Michael, I agree with your views on property and government bias and really don't understand why people are not educated, encouraged to invest in equities like in most countries. Now, I've already mentioned the lack of financial education in this country, and it should be something that should be addressed. It should be addressed. If I was in charge of a country, that's one of the things, not a compulsory subject in school, would be financial or something to do with financial literacy. And I think that would significantly improve a country, significantly improve how well a country does, how it does financially, how it does innovationally, everything. I think it would just significantly improve a country if we increased our financial education. But there are reasons why the government doesn't want us financially literate. The other thing that boggles my mind is how obsessed Australians are with property. It's ridiculous because if you look at history, the best returns for your money come through equity markets. That's not in question. That's a given. It's historically accurate. It's going to be accurate in the future as well. The best way you can grow rich is through investing in companies, not in real estate. And I have shown people the list of richest people in the world. And there's one common theme among those rich people. Build a company, invested in companies, build a company, invested in companies, build a company, not property, company. And the other thing I had to think about 15 years ago when I first started thinking about investing was, do I want to put all my wealth into the one asset class, real estate? And the definitive answer about that was no, absolutely not. So I have a main residence, a lot of money in this main residence, but I don't want to put any more of my money into real estate. Hence, why I pivoted into the stock market, and on top of that, better returns. And there's a lot of other benefits around the stock market. And I think if we did have improved financial education, a lot of the other people in this country would realize that investing in the stock market is so much better than the property market. Now, there are some benefits to the property market, but a lot of those benefits have to do with regulations and taxation, and those could change at the whims of any government. Okay, so another thing Adrian mentioned here, it probably also explains the lag in ASX200 performance since 2018, while property values have gone bananas. Now, one thing I'll say about that is if you look at the ASX200, particularly focusing on the ASX20, you'll notice an absolute plethora of low-quality companies. So we're talking about banks, mining companies, Telstra, even Woolworths isn't growing all that quickly. So I would categorize Woolworths as a low-quality company because of a lack of growth. Sure, it's defensive, but still it's not growing all that much. And the reason that's important is if you compare the ASX 200 or even just the ASX 20 to, say, the NASDAQ, There's a massive difference between the quality spectrum of both of those. NASDAQ is just chock-a-block full of high-quality companies at the top, while the ASX200 is chock-a-block full of low-quality companies that will not grow at all over the next few decades at the top of that particular indice. That's one of the reasons why the ASX200 is lagging, and one of the reasons why I barely invest in the ASX20. And the only companies I have invested in the ASX20 are those companies that are growing, that are high quality. CSL, REA Group, Wise Tech. I would even say Wes Farmers is a high quality company. I'm probably missing one. Aristocrat, high quality companies that are growing. But funny enough, when I look at a lot of people's portfolios, it's just full of the banks, mining companies, BHP, Rio Tinto, Fortescue, Telstra, plus Woolworths. You're not going to get much capital growth out of those companies. You get a nice little dividend, but not much. And that's the difference between the ASX 200, ASX 20, and the NASDAQ. And one of the reasons why I have pivoted towards investing more in American companies, because they are quickly growing, high quality companies. I won't mention or talk about your consumer discretionary rant because I have rambled on enough. But thank you, Adrian, about your comment. Let's go to James Reed, who says, off the top of my head, QQQ tracks the NASDAQ. I believe I was confused about what the QQQ was. I think I said S&P 500, but the NASDAQ makes a little bit more sense because at the end of NASDAQ, there is a letter Q, hence maybe QQQ. And path results were okay, but the CEO resigned. So this is what's it called? UiPath? Is it UiPath? Just going to get rid of this. UiPath. The ticker code's easy enough, Path. So I think it's UiPath. Hasn't been around for long. Listed on the New York Stock Exchange back in the middle of 2021. Chart looks absolutely horrendous. Now, the other week, the share price dropped 34% in one day. And I didn't have a look at the results. The share price just dropped a lot. So what's his name? James says this could be because the CEO resigned, which might be fair enough. Particularly if the CEO was beloved or liked by the market. I'm not sure if that could be true with the sort of chart we saw with UiPath. The only thing that confused me about this company, along with other companies on the NASDAQ New York Stock Exchange, this company had $1.3 billion of revenue in the past financial year, but we're not profitable. Now, this company has really good revenue growth. Revenue growth has quadrupled over the past 5 years, but they're not yet profitable. And that is one of the problems I do have with many companies, growth companies in America, is their focus on revenue growth over profitability and cash flows, particularly profitability. And it's one of the reasons why many of these companies have seen the share price dropped by a significant amount, because of their obsession with revenue growth. Now, possibly over time, that revenue growth can be turned into profits, but that is over time. And right now, the market doesn't want that time. Market is a little bit not patient. What's the opposite of impatient? Impatient. The market is a little bit impatient right now, and they want to see profitability, and that is definitely harmed Path over the past, well, since it listed on the New York Stock Exchange. So thank you, James. Infinity3033 says or asks, if you're not willing to add to your losers, Pointerra, then why is it in your portfolio? Poor capital management. I do the same thing sometimes and have a hard conversation with myself. I used to average down, and I do think that's a horrendous strategy to have, because that means you're adding to your losers, and a lot of your losers are in downward trends. So why would you do that? Because the share price is falling down, negative sentiment in the company, share price could keep on falling, could all fall the way to zero. I prefer to add to my winners. Share price in an uptrend, and there's potential share price will keep on increasing over time. So why do I hold Pointerra? One of the reasons I still hold Pointerra, and I have no intentions of selling, is because my position in Pointerra is fairly small. It's just not worth selling at this point in time. Another reason why is because even if you do own a small amount of shares in a company, and the worth of my shares in Pointerra is fairly low, might be my smallest holding, to be honest with you, you still follow that company a little bit more closely, even if that holding is fairly small. And I do follow Pointerra. pay particular attention to any announcements the company does release. And if the company can turn things around, if the company can become operating cash flow, free cash flow positive, profitable, and if we do see that the trend in the share price will change, sentiment will shift from negative, highly negative to positive, I might actually take a trading position in this company. So let's have a look at an absolutely horrible chart. So this is Pointerra. This is, in terms of the worst charts on the ASX, this would be near the top. So it's been a downtrend for a long, long time, and there's no end in sight to this downtrend. So there's just absolutely zero reason why I would even think about adding to my position in this company just yet. And that's the most important two words, just yet. I need to see proof that things are turning around for this company. So thank you, Infinity 3033. It's still in my portfolio, but no intention to add at all. James, I remember this one. Held PPY for many years. I thought that was pay. What's PPY? Initially, when I went through this video, I thought that said pay. Papyrus. Why are we talking about this company for? Chart looks horrendous. I don't even know what they do. Do they do? It says forest products. Not sure why this company was mentioned, but thank you, James YY1YD. Is there another company? For some reason, I thought when I first did this video, it was Pay and Papaya Growth Opportunity Corp, NASDAQ. No idea. No idea. Sorry, James. I have no idea who or what PayY is, except if it is Papyrus. Chris Murphy says, or asks, "Hey Kneppy, are you interested in PeopleIn, Spark New Zealand, and Eagers Automotive?" I want to call it Ape Automotives, but it's Eagers Automotive. Three important things about these three companies. Chart looks horrendous, but possible value. Possible good value, possibly cheap. So it all comes back to your priorities. Do you care about the chart? And if the chart looks horrendous. So let's have a look at PeopleIn first. I do have a priority out of these three companies. If I had to list these three companies in which ones I would buy first, PeopleIn would probably come last. So I'd probably go Eagers Automotive, Spark New Zealand, and then PeopleIn. Although PeopleIn might look the most attractively on a value basis. And I'll talk about that in a second. Chart looks horrendous. PeopleIn just looks absolutely horrendous. I did have a trading position in this company when it hit $1. Massive volume came in. I thought there was without doubt, there was going to be a bounce. There was a bounce, a very easy 20% gain in a fairly short period of time. I think it was like a week I held PeopleIn shares. And then I saw the share price rally all the way to $1.40 back in February. I thought, maybe it'll keep on rallying. No, fell all the way back down to $1. And then it fell through $1 on the 26th of April, and it's kept on falling since then, down to 78 cents right now. Now, at some point, I would have figured that eventually value investors would see some value in this company, and that would bring in a natural support level for the shares of this company. Maybe we have seen that now. We have seen a little bit, a subtle increase in volume the last few weeks. So maybe we are seeing value investors take a look at this company and go, ooh, this company looks good value. Looks cheap, nice dividend yield. I'll buy some shares. I don't care. They don't care about the trend, the share price. They don't care about the charts. Some of those value investors probably don't even look at charts. They wouldn't even have a clue. Man, that could be a reason why PeopleIn's chart looks absolutely horrendous. Why the market keeps on selling this company. There could be a reason, a legitimate reason. I just don't know. So let's have a look at the valuation of this company. Market cap, almost 80 million, so just below $80 million. Dividend yield of 13.25%. More than likely, that won't be the forward-moving dividend yield. So that's indicating that the dividends won't drop. More than likely, they will drop. That's what the market is saying right now, that this company might not even be profitable in the current financial year, and they might not even have a dividend if they're not profitable. So there is that potential. P/E ratio of 7.58. I think they had $5 million of profit in the last half year. So if they have another half year like that, $10 million of profit on a market cap of 78.87 million. So possible value, but that's the most important word here. Possible. The chart or the market says, nah, we don't want this. We don't like this company right now. Something's wrong with PeopleIn. So what I'd be waiting for here is some sign that the market is wrong. The best sign would be a really good financial result, a profit upgrade from the company. We haven't seen this company release an announcement for about, I think we haven't seen this company release an announcement since, if I remember correctly, since the half year. So we're talking about 4 months ago. Yeah. The last price sensitive announcement, company specific announcement, price sensitive announcement, was their half year results in February. There was a quarterly rebalance in March, but that's not company, well, sort of is company specific, but not because of company performance specific. But nothing to indicate that this company is not performing or is overperforming expectations. So that's PeopleIn. Spark New Zealand. First thing I'm going to do is look at the weekly chart for this company. So you could actually argue, if you look at the weekly chart and just ignore what's been happening in the last few months, this is a high quality company. So if we go back 10 years, share price is in a weekly uptrend. In fact, every single time the share price moves towards the longer term moving average channel, which is the lower green shaded area with that blue line through it. So I'll do about 100, 150 and 200 week move, or yeah, this is the week moving averages. That's a support area. In fact, it's happened 9 times over a 10-year period where there was support for this company at those levels. And those levels kept on increasing because the share price was in an uptrend. But over the past 2 months, that support level has been broken and share price keeps on falling. Now, based off this, we've seen about 15 weeks of red candlesticks. So the red share price keeps on dropping over a 15-week period. In fact, let's have a look at the monthly chart. So we're talking about maybe 3 months down. In fact, according to the monthly chart, this company has seen 5 months down in a row. We're talking about 4.5% down, 7.4% down, 1% down, 12.2% down, and so far this month down 1%. So this could be a shift in sentiment and the trend in the share price. If you look at the daily chart, it looks horrendous. In fact, the share price of this company has fallen through 2 support levels and has kept on falling. So the chart looks horrendous. So I would not be buying it, even think about buying this company just based off the chart. So it comes back to valuation. So there's value investors out there. So they're looking at value plays. Possibly Spark New Zealand is popping up on their radar. So for instance, market cap 6.86 billion, P ratio 16.46, and dividend yield 6.63%. So not only value investors, maybe income investors have this on their radar as well. Sort of like PeopleIn has a dividend yield of 13%, but maybe the income investors know, 30% dividend yield, that's income trap. So possibly Spark New Zealand would not fall into that category. It's probably have a little bit more history behind it. So I could imagine maybe value investors are looking at this company, maybe income investors are looking at this company, and maybe that would help put a support level at the current share price of Spark New Zealand. Looking at the volume, there's been a little bit of increase in volume in the last few months, but that has actually coincided with, must have been a negative announcement the company released on the 6th of May. Share price dropped 4.2% on the day and has kept on falling. So there was a bit of a gap forming on that day. So I would assume company released something negative on the 4th, what was it, 4th of May, did I say? 6th of May, sorry. So let's go have a look at the announcement. Spark New Zealand, 6th of May. And Spark New Zealand reduces financial year 24 EBITDA guidance. So that was a downgrade, and that has really fueled extra fire onto the negative sentiment around this company. And that's why the share price keeps on falling. So I do prefer this over PeopleIn just because a little bit more history here. But valuation grounds, probably prefer PeopleIn, but charts for both companies look horrendous. Now on to Eagers Automotive. This would be my number 1 pick out of all 3. A few reasons behind this. Now, let's just start with the weekly chart. Now, weekly chart, probably not as good if you just minus Spark New Zealand's last few months. If you look at Eagers Automotive, it's quite volatile. It's all over the place. So there's a lot of volatility when it comes to this company, which makes sense. They sell cars, and you would think cars can be quite cyclical at times. And right now, we're probably in a bit of a downward cycle when it comes to cars. People don't really have buying a car on the top of their priority list, particularly those who have big mortgages. So the share price has taken a bit of a hit over the past few months. So if you look at the daily chart, definitely share price has fallen. Company did release a negative trading update on the 22nd of May. Share price on that day fell 15%. So straight away, that's a negative sign. But there is one really big positive coming out of this company. One big, really big positive, and that is Nick Politis, who is he has some relationship with this company. Not sure if he's the founder or what, but he's definitely a big shareholder in this company. And I just noticed when you look at the announcements of this company, change of directors interest notice, Politis. So 3 within the past month and a bit. He's been buying shares. That can be a good sign. And there's other ones here too from Blackhawk and Cremella. So it seems like directors are buying shares on the market. In fact, there's another one from Politis in May, 22nd of May. So investors or the directors are buying shares on market. That can be a good sign that the directors think there's value in the current share price of this company. And that can lead to a support zone for the company. So let's have a look at the valuation of Eagers Automotive. So this could be another reason why maybe the share price of Eagers Automotive won't have much to fall from here. Market cap, 2.6 billion. Well, that means nothing. You have to look at other stuff. So dividend yield, 7.23%. So a little bit more than Spark New Zealand. Price earnings ratio, 9.33. Historically, that is on the low side. I actually did have a look at the historical valuation metrics for this company, and based off price to book, P ratio, and all those things, this company looks like it could be attractively valued right now. So if you're willing to hold for maybe 5 to 10 years, I think this could be a good time to buy Eagers Automotive in the anticipation that the low has almost been reached. And even if the low hasn't been reached, in 5 or 10 years, the share price will be higher than it is now. So I think it all depends on your perspective, on your investing philosophy. Now, if I was just using charts, there was no way I would buy this company. But if you're more of a value investor, maybe even an income investor, this company could be looking quite attractive at current levels. And on top of that, Nick Politis and other directors are buying shares on the market. And that can be sometimes a really good signal. Okay, that's all I've got for today's video. A bit of a shorter one because frustration. And I think I've kept calm enough during this edition that I will definitely put this onto the wild wide web. Anyway, if you have any more questions, thoughts, and the other thing I should mention is because I do have quite a bit of a backlog of questions and answers and replies and whatever to get through, I'll probably do quite a few more shorter answer reply videos over the next 2 weeks to catch up. So wait out for those during that time period. Anyway, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.